Jim, thanks for joining us. I'd like your take on digital assets and the evolution of digital assets over the next 2 years. They've come a long way in the last few years, but there's a lot of excitement about the next 2 years and the growth and evolution. What's your take?
So digital assets have grown up. Traditionally, this has been a market which was dominated by retail engagement. You had several large cryptocurrencies. If you go down chain, there were more speculative use cases. What's changed in the past few years is now institutions have realized that this is an asset class that's large enough. This is a technology that's maturing, that there's actual real world use cases beyond just an individual investor wanting to hold a token. And so when I think about the next 2 years, we're going to see a profound change in assets being tokenized. What really kicked this off is the growth of stablecoins. Stablecoins have been around for many years. Traditionally, these were an on-ramp from traditional currencies into these digital blockchain systems. And at some point, when you're comfortable, you can swap that stablecoin into a volatile cryptocurrency. But the use case has really evolved. Traditional financial institutions have seen the benefits of the low cost and fast settlement. And now, beyond just kind of tokenizing US dollars, which is stablecoins, institutions are trying to understand how they can tokenize other aspects of their business, whether that's to meet customer demand who already want these products, whether that's to improve operations. And so it's a unique time period in digital assets because until now, all activity that's happened in the digital assets ecosystem has really been tied to the market cap of the broader crypto system. And so as an example, if you think of the Ethereum blockchain, last year, the fees generated from the different areas of use, about 50% of them came from stablecoins. So people onboarding assets into stablecoins, whether that's because they wanted to earn some yield through rewards or if they were pledging them in some sort of an application. The next 20% is called liquid staking. So in a protocol like Ethereum, you can stake your Ether and earn a reward on that, right? And that helps validate the network. So you're contributing to the network and the network's giving you a reward. And then beyond that, lending. And so all of these use cases over time, as the broader crypto market grows, it inherently creates more demand for them. If you have a higher value of Ether staked, you need more liquid lending to access it. Again, on the traditional lending, if you want to have access to your underlying funds for another use case, but you don't want to sell and have a capital gain, you would use a traditional on-chain lending platform. And then stablecoins have grown as well. Traditionally, they're an on-ramp. And so the exciting thing when I think about the growth of the space 2 years from now you're having activity that's not tied to the crypto market cap. If you're a bank and you want to tokenize your deposits because it enables faster settlement, it can reduce your operations cost, you don't care what the price of Bitcoin is. You don't care where the broader market cap is. You're just focused on creating efficiencies for your business. And so that's a step change difference into what we've seen in the past 17 years of digital assets.
You talked about profound change. So in 2 years' time, we're sitting down here. What does it look like? What does the stablecoin market look like? Is it greater adoption? Is it tokenization beyond US? Is it tokenization of other assets? Give me a sense of what you see over a 2-year time frame.
So traditionally, stablecoin adoption has been the largest outside the US. If you think about investors globally, they prefer, or they've historically preferred to have their assets in dollar-denominated assets. And so stablecoins offer a way to do that. You can have essentially digital dollars that you don't need to access through the traditional banking system. So if your concerns are inflation, if you're in an emerging economy, it's an attractive asset. It's easy to trade. It's liquid. You have it at your fingertips. The biggest change really came last year with the passing of the Genius Act in the United States, and that provided regulatory clarity around stablecoin usage in the US. And so I would expect stablecoin market cap to now grow more in developed markets. The use case in the US is much different than outside the US, right? Again, in the US, you're less concerned with having access to your money. The financial system, and it's not just the US, more developed nations broadly, The financial systems work. I can quickly transfer you money. I know it's going to get there. I can transact digitally through credit cards. So the use cases are actually emerging almost similar to a money market fund, where investors are realizing I can earn a reward on some of these, and that's an attractive alternative to keeping some of my everyday in cash. And so I would expect in developed markets more stable coins to grow. And what we're seeing there is what you would expect in any competitive market. Banks are seeing this. They see their customers like the instant settlement. They like the 24/7 access to their money. And so they're willing to meet them there by offering tokenized deposits, tokenized money funds, because it's a lot of the aspects of a stable coin within the context of kind of how a developed market uses them.
So finally, does this enable trade? Does the adoption, the increase in the use of stable coins and digital assets more broadly, does it enable participants to enter into global trade that may not have previously been able to do so?
I think so. So if you're a participant that maybe didn't have access to the U.S. dollars, the U.S. dollar is the global reserve currency, and it enables you to do that. I don't mean that in a way outside of the traditional system. There's a lot of change going on right now, and the interesting thing is stablecoins actually are a transmission mechanism for the U.S. dollars globally. And so even amid this change, if you think maybe global partners are questioning their relationships with the U.S. just because of uncertainty or whatever it may be, it's a new transmission mechanism for U.S. dollars globally. And so trade changes over time, but I actually think stablecoin growth really actually reinforces the U.S. dollar reserve as the primary means of global trade.
We must leave it there. Thank you very much indeed.